Hello, my name is Jingoneli, and today we are going to be looking at another tutorial. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams.
Liabilities. From accounting, we all know the non-current liabilities. We can have, for example, long-term loans. We can have the bonds. We can have the loan notes payable, and any other liability which is to be paid in more than 1 year. So we're saying that what do we test? These are items in the statement of financial position, or what we call the balance sheet. What we test is completeness. Were all these non-current liabilities recorded? Do they exist? Are the rights and obligations? Do the business you're auditing have the obligation? Did they actually borrow the money? So valuation, allocation, and accuracy, then also presentation. How have they been presented? Have they made the necessary disclosures and all that? So, for example, you find that there's a loan of UGX 100 million. Now, how do you verify? You want to verify whether this loan exists, whether it is completely recorded. One, there will be agreements, loan agreements with the bank. So you're going to review them. Once you review them, you confirm whether actually the loan was acquired or not, and the exact amount that was acquired. You're going to write to the bank. You're going to obtain confirmations from the bank. To confirm, you inquire from the bank, did this entity, ABC Limited, borrow money from your facility, from your bank, or not? They will respond to you, confirming whether they borrowed or not, and how much they actually borrowed, how much have they so far repaid, and how much is remaining. You're going to recompute or to recalculate the installments. Confirm, are they paying the right installments? You get it. The outstanding amount and the balance. We can also check the loan repayment schedule and confirm that the client, the auditee, is paying back. Because if he doesn't pay, then they'll fine them their penalties of not paying. You're going to compare the loans or the long-term liabilities of the current year with the previous years and the budget, and confirm and investigate increased borrowing, because increased borrowing could be problematic to the entity. But also, here there is a ratio. You're going to compare the gearing ratio. Compare the gearing ratio for the current year with the previous years, and the industrial average. The same industries, how much are they borrowing? The same companies. And investigate significant differences. If similar companies are only borrowing, what's the gearing ratio? If it's only 40%, why is yours 70? Why are you borrowing more than the other companies? Will you manage to pay? Is the industry able to generate enough profits to pay back the what? The loan. So that's why you are comparing the gearing ratio. You want to know your gearing ratio, your amount of loan compared to the total to equity. How much loan is there? How much debt is there? How much equity? Is your debt more than equity, or equity is more than debt? If our gearing ratio is high, then it shows high leverage levels. So high gearing ratio shows high financial leverage, which could lead to failure. It can lead to failure to pay back the loan to honor the timely repayment of loans. You get it. So we want us to investigate whether the loan is being used for the intended purpose. That's also very key. Is it being used for the intended purpose? You can investigate, you can inquire, you get it. Or they channeled the money to other things. It must be used for the intended purpose. But also we're going to analyze the net profit margin of the current year and the previous year. Confirm that, to confirm or to investigate significant decreases which may lead non-repayment of interest, because interest is paid from profits. So if profits are decreasing, that means you may not be able to pay your interest. So I'm just brainstorming these tests, and this is what I could basically test on loans. You get it. Also, I'm going to analyze the loan repayment schedule, the loan, cancel bond, debenture, etc. repayment schedules, and confirm that proper classification of loan between current and non-current components of loans as current and non-current. Remember, we always prepare loan repayment schedule. The amount you're going to pay the next year is the current liability on that, the installment. For example, you have a schedule now. The installment you're supposed to pay next month or next period is the current, yeah, because it's going to be paid the next 12 months. Then the installments after that are non-current. Yeah, you find opening balance, and then you have the interest, then you have all coupon paid, interest paid, and then you have the closing balance. Now, if the borrowing was 2 million or 200 million, and these are the terms of bond face value is 200 million. That's the amount you're borrowing. Then the coupon interest rate is 6%, is 10%. So you preparing a repayment schedule. So you find this is 10% interest, market interest, by a coupon 6. Now this means that when bonds are being issued, they have two rates. Bonds have two rates other than, for example, government is issuing a bond to NSSF to get money. Government will go to NSSF and say 100 million. Now, the government of Uganda is willing to pay NSSF for the borrowing. But NSSF will argue that, or we say that 6% is not enough on the market. So 10% if it accepts. On repayment, government of Uganda will pay 6% per year, fixed per year as a fixed amount, and pay the 10% at the end of the bond period. Somebody who has named him or herself as recording in progress, please mute. So government of Uganda will pay 6% as a fixed amount and pay the 10% of the bond at the end of the bond period. This is how IFRS 9 works for bonds. Government was willing to pay only 6%, but the lender NSSF said it is small, so it requested they add 10%, and they accepted. The government accepted to add the borrower, so it will end up paying 16%, but it doesn't pay this 16% at once every year. It pays the 6 per year, then the 10 is paid at once at year end, at end of the bond period. So bond period, let's for example say is 3 years. So meaning the opening liability is 200 million, then the coupon rate we've said it is 6%. So the total interest is what? Is 10 plus 6, which is 16, but the 10 is going to be paid at the end. 16 is being paid per year. So what will be the coupon rate? And this one is fixed as an annuity. So 6% times 200 million, what do you get? You get 12 million. So every year government will be paying 12 million to NSSF, but the interest will be, the 10% will be 20 million. So meaning the total outstanding amount here will be 220. But out of 220, they only pay 12 for that year, meaning the remaining is 208 as the balance, which they bring to the next year. They start with in the next year, in year 2. This is year end. Year 1, 2, 3. The bond has 3 years. Total outstanding amount. Can't you set have added 200 plus 20? The opening balance, what you borrowed plus the interest. Then minus what was paid. We remain is 208. Then we're going to get 10%, which will be $20,800,000, like that. So the total outstanding amount will be $228,800. But we only pay 12 million. I said this is fixed. And then we remain with 216,800. And then finally, you start with that in the third year as the outstanding liability. And then you get the 10%, which will be 216,800. Then you add the two. So finally, the outstanding balance will be 250. Now, in your financials, the classification of this amount. In year one, what to be current liability, what to be non-current. So classification at the end of year one. Classification at end of year one. So this is the year one statement of financial position. We have current liabilities and non-current liabilities. We have bond and also have bond here. Now, this amount at the end of year one, the total outstanding amount is 208, like that, 208. But by year two, it will be 216,800, and then year three to be that. So you must classify this into current and non-current.
Excuse me, sir.
Yes.
You have a wrong figure. The last one.
What do you have?
Now it is okay. 226,480.
Yeah. So in the next year, what will be paid? They will pay 12 million. Yeah. 12 million will be current. The one that will be paid. So the 12 million you're going to pay next year, this one becomes a current liability. You get it? So proper classification to be current liability. It keeps increasing because we are not paying. We are only paying 12 million. A bond is different from a loan. For the loan, it keeps reducing, but for the bond, it keeps increasing. because the bond will only keep paying the coupon interest, we pay the other amount at end of the year. They taught you these things in accounting 3. So these are the only payments that they keep paying. The rest is paid at year end. So at year end, what have total outstanding balance at year end, if you add here, the interest will be, the total will be 62,800. Then for the coupon, we shall have paid a total of 62. This one will be 36. And then this is the outstanding balance. So total outstanding balance at year end, at the end of 3rd year, we have paid so this is the amount which is outstanding at the end of the 3rd year. Then, but for the bond, this was the one that we entered with in the 3rd year. And this was the outstanding. We removed 12 million and it remained with that. So this is the total outstanding, which they must pay now. $226. So what has been paid? Total paid is 36 million. Then total interest is 62,480,000, like that. So when you're in year one, we have only paid 12 million, yeah? We have only paid 12 million. The rest is outstanding. So in year 2, the 12 million you're going to pay in year 2 becomes the current liability, like this. Then the non-current liabilities in year 1 will be 226. Will be whatever is outstanding, and that is basically whatever is outstanding, that is in year 2 and in year 1. Yeah. So when you're at the end of year 1, you have already paid this. So whatever is remaining that will be paid in year 2 and in year 3, that is a non-current liability. So that's why I'm saying that there should be this test. Analyze the loan, bond, debenture, its repayment schedules, and there should be proper classification in the form of the current and non-current liabilities or obligations. What is the installment that we're going to pay next year becomes current. Then the ones after next year becomes non-current. So these are simple tests I've developed for you. Same as the one in the documents, the memorandum of articles of association. Remember this in Companies Act, Section 5, Section 6. It distinguishes between a private limited company and a public limited company. They show you that to register those companies, there must be a memorandum and articles of association. And in those documents, one of the items there is the authorized share capital. The capital the company intends to raise in its life. So when you compare you agree the authorized share capital with what is in those registration documents to confirm that this company is on the course of raising its capital or not. Then in case of any changes in authorized share capital, this must be authorized you look for the board authorization. Initially, they might have intended to raise 2 billion, but along the way, they found that they need more than that, so they revised it. But was it authorized? Then for the issuing of shares, we must confirm that the management was authorized to issue shares. We look at the minutes of the board meetings and the shareholder meetings. For when you sell shares like MTN did, cash is received. We must compare the amount of shares sold and the cash received. They must be rhyming. Of course, we look at the bank statement and the cash book. Because they made sell shares and steal the amount, so we want to confirm how many shares were sold, how much cash was received. Were the shares sold at the right price that were agreed upon in the meetings? Then you recalculate the split proceeds to confirm it's correctly recorded in the share capital and share premium. You remember in company's account, some shares you can sell them at a premium. You must split. Share capital is credited to share capital account, and then the premium is credited to the premium account. That must be split. It must not be bundled together. Sometimes we transfer shares to other shareholders. You're a shareholder in MTN, but you feel like you no longer want to hold them. You go back to your dealer or to the broker, and they transfer your shares to a different person. So what transfer forms filled, were your certificates, you already have share certificates of ownership of shares in MTN, this should be cancelled, and the minutes of the board approving that a certain shareholders' shares should be transferred to another person. Also agree the balances on the shareholder account in the share register, and the total list with the issued share capital in the general ledger. They should be the same. So this is what you studied in year 2 under company accounts, and that's what you're basically just verifying whether it's being done correctly or not. So if you've already forgotten your accounting too, you need to get back at the book and remind yourself. Then we go to audit sampling, which should be the last part of this topic.
Excuse me, sir.
Yes.
Let me take you back to the audit of equity. I want to specifically know the assertions we are trying to verify.
COVEP is an item in the balance sheet. So COVEP. Completeness, rights. Do we have rights over the shares? Are they existing? Then evaluation, like this one tests the valuation, this split. This cash received, valuation and allocation. You get it, eh?
Okay, thank you, sir.
And then presentation. Audit sampling. This is the last part of this topic. Now for audit sampling, an auditor is allowed to audit samples, audit using samples. You may not audit everything. There are reasons why you may not audit everything. So why do you think we may not audit everything? Why? What are the instances where we may not audit 100%? Who can tell us? Yes?
Limited time.
Limited time. What else?
Limited resources.
Limited resources. Any other?
Unskilled workers.
Which one?
Limited access to the information.
You want to pay for Spotify?
Limited access, yes.
It's expensive.
Expensive to audit everything, yes.
When the client is not really highly risky.
When the client is not very risky, yes. Effectiveness of controls, yes. Large volumes of data, yes. Inadequate skilled personnel. You're supposed to have skilled personnel as an auditor. So that one is not a good reason. Some branches are very far. So those reasons and many more others may not allow us to audit everything or to audit 100%. So the standards, the audit standards requires us to, or allow us sometimes to, or even most times, to audit samples, to audit a part of the entire transactions to get it. So, but when you now you studied statistics, how do we select an adequate sample? Because there's a risk of selecting a sample which is not adequate, and you will not see the risks of material misstatement. So how do you select a sample that is representing the whole population? A sample where there are errors. Sometimes I go with young auditors to audit, and I just the way I select my samples, I just tell them, look at this transaction, look at this and this, and they're always amazed that the ones I pick are the ones with issues. So, how do you select samples, and those samples are the correct samples, or the ones with issues? In statistics, you studied the sampling methods. So, how do you select the sample from your statistics? Those who got 90s in statistics, business statistics, how do we select samples?
Snowballing.
Snowballing. What else? How do we select adequate samples as per your statistics?
So I think we can use clusters.
Use what?
Clusters.
Clusters. Somebody saying you choose randomly. Yes.
By grouping the items.
How else?
Select ledger books.
You can do stratification.
Stratification, somebody already said clustering, I think it's the same thing. Random, simple random method. What else?
Sampling.
Probability sampling techniques. What are they? Do you remember them? There's probability and non-probability. Sampling techniques.
You can do desired assurance.
Desired what? So you must remember sampling techniques. What are the techniques you can use to select the right sample? You have receivables. The receivables are 1,000. There are very many. You can't audit all of them. How do you, out of the 1,000, how do you select the receivables? And those receivables you select are the ones with the issues. So people have given certain methods: simple random sampling, stratified, systematic, and many others. So we shall see how we use those methods, select a sample. Then how do you determine the sample size? Like if there are 1,000 data, how many do you audit out of 1,000 from your statistics? What did the statistics tell you? What is an adequate sample? In terms of number, sample size. How do you get sample size?
You can divide the population.
Divide it by what? There's a formula for sample size.
The big N divided by the small n.
So how do you get a small
n? Is the number of and remember the big N is the number of population, then the small n. Yes.
So how do you determine the small n? Audit sampling approaches used here.
The people of Uganda, as long as they have the people of Uganda, as long as you can still actually thinking about that. And their pressure on us.
Dear Oscar, you mute.
When I was waiting for you to keep quiet. Okay? We're saying that
Alright, sir.
audit sampling is all about auditing less than 100% of the population. But our sample, population has large values, sometimes has large amounts. We may not be able to audit everything. But there's a significant risk that if we select samples, sometimes we may not select adequate samples, and sometimes we have to use computer-assisted audit techniques, the CATs, to cover more. We call them the computer-assisted audit techniques. Can be used to electronically test the whole population, but these ones, they don't do all the tests. They can only do a few of them. They can only do like analytical procedures, only the calculation. So even though we can audit using a computer, you study it in topic 7, but the computer can't test the softwares. They can't test all those assertions. They can't do all those procedures. They can only do the calculation and maybe analytical procedures. So we find that in most cases, we must go back and audit a few items out of the large population. So what do we pick in a sample? We can pick high-value items. When you're picking a sample, what do you base on? You can pick high-value items out of the population. Like if you have 100 data, but you only want to audit like 70, you can pick the ones that have high values. You can pick the ones that are susceptible to misstatement. Like if you're auditing inventory, there's inventory that can easily be stolen. So that's what you can sample out. You can sample out unusual items that are like related party transactions between the business and its employees. You can also obtain items about matters such as nature of the entity, nature of the transaction, and internal controls. Then you find that as per the nature of that entity, you find that item is risky, so you can sample it. Also, the nature of certain transactions. Some transactions are having high values. Some of them are so small they can easily be stolen. You get it. Or sometimes the policies describe certain things as being risky, the internal controls. So that can be your basis of selecting these items. Then you must also obtain information about the entity to find out which items are risky. Like when you perform analytical procedures, it will show you that in a certain month, salary is reduced. So you can pick salaries for that month just because there was an increase or a reduction. So we have been doing these analytics when you compare. If you find that in a certain month there was an increase, then that is evidence that there might have been an increase. That item might be having issues, so you can select it. So these are some of the reasons or points we base on to select items out of the population. Also, you may select items to test the operation of the certain control activities. You want, for example, to find out whether approval is working. So you can select a sample of payment vouchers to confirm that they were signed by the right people, they were approved by the right people. So that is what we're talking about. Then benefits of audit sampling. What do we benefit from auditing samples? Auditing a few out of the total population. Then it enables auditors to give reasonable assurance, yeah? Because if you audit everything, you may never finish and you may never get a clear picture. But when you focus on like 70% of the entire population, you have enough time to dig deep into those transactions, and you may find an error in one transaction, same in another transaction. So when you go into deep, you go into the roots of that issue, and you can end up giving a good opinion, other than just testing many, and you don't get the actual problem, you get it. So you test, use a sample, so that you pick a part of the problem, not a few, but in fact, in statistics, they told you we audit more than 70%, even if it is sampling, but we don't only audit 40% or 50%. We audit at least 70% of the population. So it will give you time to dig deep into the transactions and find out the actual problems. Also, auditing every transaction may not provide absolute assurance on the material misstatements. Remember, absolute assurance, reasonable assurance is when you test up to acceptable levels. Study this in topic 2. Absolute assurance is when you prove that everything is correct. In auditing, we don't want absolute assurance. We only want reasonable. So if you test every account balance and transaction, it may again not give you 100% correctness. So why do you again test everything? Because remember limitations of an audit. There are many other reasons why you can't achieve absolute assurance. In topic 1, they taught you the limitations of an audit. Most of you are not in class. So even if you do 100%, you may never achieve the absolute assurance. That's why in auditing, you're only required to give or to test for reasonable assurance. Also, it reduces audit costs as few transactions and balances are tested. Then, there's what called sampling and non-sampling risk. Sampling risk is when you base on your sample and you give a wrong conclusion. The reasons are you might have selected the wrong sample. For example, you come to MOBS, you want to sample some students. Instead of speaking to a year 1, year 2, year 3, you only choose year 1s. You'll get the wrong information. The way you selected your sample was not the right one. You not get to know the issues with third years or second years, because you've only selected year 1s to represent the entire students in MOBS. So that will be sampling risk. So sampling risk arises if you select the wrong sample. If you select an inadequate sample, you get it. Inadequate sample, wrong sample, you're going to end up having sampling risk. You're going to get a wrong conclusion. You're auditing, for example, payroll. You only select employees who have just joined. You leave out those who have left. So you not know the issues with those who have left. You select employees in one category of salary. You don't select others in another category, those who are earning more money. You only select those who are earning small money. So you're supposed to select a sample that is including the entire population. If it's a payroll, select the trainees, a few of them. Select the people in management, a few of them. Select those who are those who have just joined, those who have just left. So you mix it like that so that you have the correct sample. So if you select the wrong sample, you will conclude that controls are working, yet they are not working. You will also conclude that controls are effective, yet they are not what? Effective. You either say they are more effective when they are not effective, or you say they are less effective when they are actually effective. Or you conclude that the amounts are correct when they are not correct. Or you say they are not correct when they are correct. Then we have the non-sampling risk. Here you have the correct sample, but again you give a wrong conclusion. This will be due to other reasons. You have selected the right sample, but you again have a wrong opinion. So, like for example, in inappropriate audit procedures, for example, if you don't recognize a misstatement, and also misinterpretation of the evidence. So, you should always avoid these risks, the sampling risk arising of the wrong sample you've used, or the non-sampling risk, which is from other factors. There are stages we follow while selecting a sample, and one of the first stages, you first determine the sample design. You studied this in statistics, I will not repeat them. Size and then selection. Sample design in the statistics, they told you, that can be in terms of, are you selecting items that are there right now? You get it. So, when designing an audit sample, the auditor considers the following. What is the audit objective? What do you want to test? Here we'll go back to the assertions. Do you want to test completeness? Do you want to test existence? If you want to test existence, now your sample design will involve physical items. You get it? Because you want to test what? Existence. If you want to test completeness, your sample design will also have, for example, ledgers, documents. You get it? So what do you want to test? Determines how you are going to design your sample, what you're going to include in the what? In the sample. Are you going to look at the source documents? That is if you want to test, for example, for completeness, for accuracy, and all that. Then you also need to know the population. How much is the population? Because the sample comes from the population. Population is the total number of items in the ledger. For example, the total receivables, the total payables, that gives you the population. Total assets, that's the population. So the total for each account is the population. And you select your sample from the population. Then from the population, of course, you will come up with the sample size. People are giving us formulas of sample size. But if I select the sample size, so out of the population, for example, if data is 100, out of 100, what should be the sample? Let's say if you want 70%. So that will mean out of 100, the sample size is 70. But how do you determine the 70 without being biased? So we are saying that you look at the tolerable rate of deviation. If you are selecting the sample size, one of the things you look at, you must set what's your tolerable rate of deviation. Tolerable rate of deviation, TRD, will mean the rate of deviation from the prescribed internal control procedure the auditor is willing to accept. If somebody has deviated from the correct internal control, for example, they are supposed, when you look at one of the controls is documentation. They're supposed to keep documents. If you find that certain documents are not kept, what that deviation, how much is it? How many documents have they not kept? How much controls are not in place? How much deviation you are willing to accept? So when you're selecting sample size, that one is fundamental. Knowing what is the tolerable rate of deviation from the prescribed internal control procedure. There is a prescribed internal control procedure. For example, the document must be signed by the financial manager. That is the prescribed internal control. But you find it was signed by the accountant, meaning there's a deviation. There's a deviation. It is supposed to be signed by the financial manager, that's approval, but the financial manager maybe was not there and the accountant signed. So there is a deviation. As an auditor, can you accept that or you can't accept that? Can an accountant represent a financial manager or not? So you must state your tolerable rate of deviation. How much are you going to accept as an auditor? If you find that they've deviated much from what you expected, you can increase your sample size. So how many you sample can depend on the tolerable rate of deviation, the deviation from the right things. If you find that they have deviated too much from what they're supposed to be doing, then you will increase your sample. But if the deviation is small, they're almost doing what they're supposed to be doing, then your sample size will be small. That's what I'm talking about. Deviation, by how much are they not doing what they're supposed to be doing? If you find that they're deviating by large figures, the sample is likely to be high. You audit many things because they are deviating by high amounts. But if they are deviating by low amounts, or by the deviation is not so big, then you might have to select smaller samples. Any questions? So that's how tolerable rate of deviation determines how much sample you will select. Then the tolerable misstatement, how much misstatement can you tolerate? If you can tolerate a small, if you find that there are many misstatements, then that means you can't tolerate them. Every account you start auditing, you find it's not correct. There's a misstatement. So meaning, if there are many misstatements, you are not willing to tolerate them. Your sample will be high. You select a high sample to confirm what is bringing those misstatements. But if the misstatements are few, meaning you can tolerate those ones, so you may not select a big sample.
Excuse me.
Yes?
Can you please pardon on non-sampling risk?
I said non-sampling risk is the risk arising out of reasons which are not concerned with the sample. The sample was selected correctly, but you, the auditor, you're giving a wrong opinion because of other reasons, other than those coming from the sample. The sample is right, but because of you using the incorrect procedures, that's why you have a wrong opinion. Because of you failing to plan for the audit well, that's why you have a wrong opinion. Those are non-sampling.
So can you show me the risks that arise? Excuse me, sir.
Yes.
Can you say these are risks that arise from the auditor's efficiencies?
Other than sampling.
Yeah, other than sampling.
Yes.
Okay, thank you.
Excuse me, sir.
Yes.
Yes, you have said that if you find that the entity is having effective internal controls, you might set your tolerable statement higher.
Low.
But
You
can set it low. Like, yes, the sampling size. What do you mean by low sampling size? Yet we had said that it should be at least 70% of the total population.
Now, initially you may go with knowing that you're going to audit 70%, but even that 70 can be reduced. If you find that the entity is doing well, the figures are correct, the controls are effective, you may not have to reach 70%. You can stop like at 50 or 60, yeah? This sampling size is not static. We keep changing it. For example, I start auditing receivables. I find the following order controls in receivables are effective, are working. There are no much misstatements. So why do I waste my time to continue and audit everything, audit 70%? I can stop at 60, I can stop at 50, and say that the account is okay. You get it? And then I go to another area like that. That's how it's done. Then the expected rate of deviation. When you go to audit, you expect a certain rate of deviation from the best practices or from what you expect. So if your expected rate of deviation is high, then you start by selecting a high sample size. Remember, these factors are determining how much sample size are you going to have. So you might go, you've been seeing this client in the news, he has been having issues. Even in their meetings, they briefed you, they suspect the CFO stole some money, they suspect people are not doing their work. So you go expecting to audit a lot. Why? Because of the surrounding conditions. The CEO has briefed you that his workers he's not understanding them himself. Assets are getting lost. Assets are not being used for the company's work. They suspect on the payroll there is ghost workers. So there you go expecting a lot of misstatements. Your expected rate of deviation is high. So you're also going to select a high sample or a big sample because you expect that they've deviated much from what they're supposed to be doing. So still here, expected rate of deviation gives us the expected misstatement. So even when the expected misstatement is high, the sample is likely to be high. assurance level can also help us in determining sample size. If we want to, remember, we have 3 levels of assurance levels, 3 types of assurance. Absolute, reasonable, and limited. Absolute assurance, here we want to test or to confirm 100% correctness. Now here, our sample may be 100% sample size will be high, sample size will be big, get it, almost 100%, because you want to test whether everything is correct, yeah? That's if you want absolute what? Assurance. And then reasonable assurance, the one which ISA 200 allows us to do. For reasonable assurance, this one, the sample, e.g., you want to test correctness up to a certain acceptable level. So this one, e.g., 95%. So this one you may not select very big samples, because you also don't want to test your objective is not to test everything, the correctness of everything. So it will also determine your sample. You get it? Kaveja, can you mute? So assurance levels, what do we want to achieve? The confidence level we want to achieve. Confidence level means which level of correctness do you want to test? Do you want to test 100% correctness, 95% correctness, 80% correctness? So if I want to test 100% correctness, I will audit 100% my sample. If I want to test 95% correctness, I may have to audit less than even 95. You get it? So also level of assurance can determine how much sample you want to correct. So we have looked at 3 points: your tolerable rate of deviation and tolerable misstatements, what you can tolerate. If you are willing to tolerate less misstatements, then your sample is likely to be high. You get it? But if you tolerate more misstatements, then you find that your sample size may be low. We are talking about the expected rate of deviation. If you expect a high rate of deviation, your samples will be high. But if you expect a small rate of deviation, then the samples may be low. And then assurance level, which assurance do you want, absolute or reasonable? If you want absolute, you audit more. If you want reasonable, you audit lesser than the one of absolute. These are the same points here. Then factors influencing sample size for substantive tests. How much do you test in the financial statements? We can look at assessed risk material. How much risks have you assessed? If you have assessed high risks, then you end up auditing more. You remember you assess risks during audit planning. So as they taught you that in topic 3. When you're doing audit planning and you assess high risks, then when you reach the audit of the financials, you have to your sample size will have to be big. Evidence from other substantive procedures. For example, the major one is analytical. If you start with analytical and you find there are huge differences, then you may have to increase your samples. Then desired assurance level. Do you want to achieve 100%? Do you want to achieve 99%, 95%? We also determine assurance level. Tolerable misstatement, we already looked at that. If the lower the tolerable misstatement, the larger the sample size. If you want to tolerate less misstatements, you only want to accept less misstatements, then you audit more. You get it? Because you have to audit everything and you find that there is no any misstatement. Expected misstatement If you expect high levels of misstatement, then you audit more. Stratification of the population. If the population is highly stratified, it's big, it has different sizes, it has different clusters, then you may auditing more. You find like you're auditing Crown beverages, you must audit Mirinda Fruity, Mirinda Orange, Mountain Dew. There are many products, there are stratifications. Then you may find that your sample size are more. But if that business is not highly stratified, then you may end up auditing less. If you come to MOBs who have many programs, you may have to audit every money from every program. So the samples may be more than auditing a primary school where the stratification may not be so much. Then the number of sampling units in the population. Here we look at it can also determine your sample size. Sampling units, that's the total population. The larger the population, the higher the sample is likely to be. We're going to look at the monitor unit sampling. So those are some of the factors that determine how much sample size we shall select. Types of sampling. This is studied in statistics. There is statistical and non-statistical. Statistical sampling, here we use probability, and all items have equal chances of being selected. So it is random sampling, where any item can be chosen or can be selected. And then we use probability theory. But in non-statistical, you just use your knowledge, you use your skills, use your judgment. You just select haphazardly without following any scientific method. That is non-statistical. So in statistics in year 2, they taught you all these things: random simple sampling. Random, that's when you use rotary numbers, or you use random numbers from using Excel or the computer, or you use the rotary method. Rotary method, this is when you write the names of the items in the population on pieces of papers. You put them in a basket, you shuffle them, and then you start picking until when you reach the sample size. That is random sampling, which is studied in statistics. So I don't want to spend more time on it. Then statistical systematic sampling, we also studied it in statistics. Under systematic, you get the population divided by sample size, get the interval. So the interval is what you keep skipping. For example, if the population is 800 and the sample size is 40, out of the 800 you want to audit only 40. The interval will be 20. So you select the first item, then you jump 20, you select another one. You jump 20, you select another one. So the interval is what you keep skipping. Now that is what? Systematic. Then monitoring sampling. Now for systematic, you can start from any end. That's why all items can have equal chances of being selected. Now for monitoring sampling, this one we select based on the money units, on the actual amount. I will show you how it works later on. Then you have hazard sampling. This one you don't follow. This is non-statistical. You don't follow any order. You just pick any item you find there haphazardly. Just using your skills, your techniques, without using probability. Block sampling. Here, you divide the population into blocks. Like if you're auditing Crown beverages, you can divide it in terms of regions. They distribute soda in Western Uganda, in Central, in Eastern. So their data, you can divide their data in terms of regions. Each region will be a block. Eastern region data, Western region data, Northern region data, Western region data, like that. So that is block. But from each block, you select the population you select the sample using random sampling, yeah? The block sampling just divides. Then after dividing, you come back up here, use these methods. You can use haphazardly. You can select haphazardly, or monitoring sampling, or systematic, or random. The block will just divide the population into blocks. Then performing audit procedures. How do you perform audit procedures on a selected sample? When you select samples, you must apply audit procedures on every item you have selected. I'm going to come back to monitoring of sampling with an example I told you, so be patient. When you've selected a sample, you apply audit procedures to each sample item selected, and then, but if the selected item is not appropriate, then the audit procedure is performed on replacement item. Yeah, you might select, for example, a delivery note, but you find it was cancelled. It never delivered any goods. Yeah, so you go to another one, the one that replaced the other cancelled one. Yeah, and then also, if you selected an item to audit it and you find that it got lost, what do you do in this case? You may not apply the audit procedure on the item that was, on the documents that were. What I'm meaning, you select a transaction, but you find its documents are not there. They were lost. So you not audit that one. You record as a finding that we selected this item, but it was, the source documents were not there. Then as you audit your samples, you must find out the cause of the errors, what is causing the errors. You must identify anomalies. You may find that some items are highly misstated than others. Then if you find deviations, if you audit and you find that an account is having a lot of deviations, you might have to increase the sample. We are allowed to increase samples even when you are already auditing. You are auditing, you find things that are worse. So you had planned to audit 60% of that item, you may take it to 90. You find a fraud, there is suspected fraud. A few you've looked at, there is suspected fraud. You just continue and complete the whole of it 100%. But if you start auditing, you had picked 70 items out of 100, you find they're all okay. You audit 40%, everything is okay. So you might use your judgment by the words and audit. You might say this one is an account which is not having a lot of issues, you close it, you stop like at 50%. Then I want to go to some examples here. I want to go to a sample of monitoring sampling. We said it is one of the methods you can use to select samples. Is here on towards the end. Now, under monitoring sampling, this is how it is done. You have these are your receivables, for example, and you're going to use monitoring sampling to find out, do I audit A, do I audit B, do I audit C, how many do I audit? You get it. So what do? You first get your sample size up here, as you can see. Purpose of the test, we want to audit receivables. So what's the purpose of the test? We want to verify existence of receivables using confirmation letters. Then the risk of material misstatement in an assertion. We find that the risk is high. These data may not be existing. Population to be tested, trade receivables at the end. Total value is 177,203,000. Specific item to be examined separately, their amounting is at 8 million. Risk reduction obtained from tests of controls, none. Controls, you've not reduced your risk because controls are also maybe not working. Confidence level you want to test, you want to prove up to 95%. And then total misstatement 15 million. You can only tolerate misstatements of up to 15 million. This one you just use your judgment, or 8.5% of the population fund. So what do we start with? We first get the sample interval. Sample interval, we said it is the total population. Then you divide by the sample you have selected, the sample size. Now, from here, for example, we said that our total population is 177,203,000, and a specific item to be examined. This is like our sample size. So we find that we're going to get the population minus the specific item we want to examine. Then we find that we want to test only out of all this. You want to test 95% correctness. You don't want to do 100% correctness, but you only want to do 95% correctness. Whether the 95 is correct, is it correct up to 95%? Because that's normally our reasonable assurance. We normally do 95% correctness. In most cases, that's what we call reasonable assurance. So what do? We must get, when you come down here, we must find out what was the total population, for example, for these receivables. When you add all of them, you find it's 138 million, all of them. So the first thing we do, if I can first remove these ones for you. Under monitoring sampling, we are basing the sample size collection on the values of the receivables. So you first accumulate them. You first do cumulative total. So like this, the first receivable has 4.7. You accumulate it. You add 4.7 becomes the first amount here. Then you add it to the 3, you get 3.5, you get 8.2. You add the 1.8, you get 10.05. You add 2.7, you get 12. You add 950, you get 13. You add 2.5, you get 16. This is how you have accumulated them, like this. Here I'm putting 138 because these arrows show that there are others here. There might be other receivables here, but we assume all of them are totaling to 138. But for this example, we are stopping here on only these. So these are not adding up to 138, but we assume there are other transactions here. So what do you do? The first step of monitoring sampling is accumulate the amounts. You accumulate them like you see here. 4.7 plus 3, you get 8 plus 3.5, you get 8.2. You add that, those are the accumulated figures. Then sampling interval. You must get the sampling interval. Now this sampling interval, we just determine it randomly. We use random numbers to determine the sampling interval. So sampling interval is determined using random numbers. Is determined using random numbers. You've ever been on TV and you saw you see those people spinning that thing, and they just stop at once. They select a number. They again stop. They select a number like that. They again stop. They select a number like that. So sampling interval, you can select it randomly like that, or you can use random numbers like you saw here. So if we start with the 4 point, if our first amount is 436, if our interval is 5 million, so we keep adding 5 on each amount. So from the 436 we add 5, we get 5.4. From the 5.4 we add 5, we get 10 point that Then from here we go to 15. This is supposed to be the 15. Then from here we go to the 20. Our interval is 5, assuming our interval is 5. We're going to put 25. So determine the sampling interval, or by dividing the total population by sample size. You divide the total population by sample size. Get that interval. What you'll be skipping, what you'll be adding, with the next figure. So when you add, for example, the first amount here, if we start with the 4-3, now where do you get the 4-3? That one can be selected randomly as the first shilling. You see here? You can select it randomly, the 436, the amount to start with. So you can say our starting point is 436. You select it randomly. Then you just keep adding the interval, which is 5. So you are skipping 5. After 5 you skip, you select another one. You select another one like that. So somebody was asking, how do you get the 5? The 5 is the sampling interval, which you get by dividing the population by the sample. That's what I started with. Divide the total population by the sample. And in our question, you remember what was the population? The population was, so the sample interval here, we look at the population 177,203 divided by 38,340, like that. You will get around 4.6, but you can't skip 4.6, but it's hard to physically skip 4.6. So we rounded it off to 5M, yeah? So after accumulating your figures here like this, you get a starting point which you can select randomly. This one, the 436 on the first customer. Then you keep adding 5, you keep adding 5, you keep adding 5 like that. So what do we include in the sample? What we include in the sample is whatever is below this amount, accumulated amount. So, but what is above, you may not select, yeah? So what do we select here? There is yes and no. Here we can say select all the items which are above. If this figure is above, then we do what? We select, like you see, this one, the 4.6, if the accumulated figure is above, so select every accumulated figure. Okay, let me write it here. Remember, these are the steps here above here. I said start by accumulating the amounts, then get the sample interval. From sample interval, select all amounts above amounts in the accumulated amounts. Select all accumulated amounts above the sample interval. So you come here, the 4.7 is above the 436, so we select that. The 8.2 is above the 5, we select that. The 10.0 is below 10.4, we don't select. The 12 is below, even this one we don't what? Select. The 13.7 is below, we also don't select. The 16 is below, we also don't select, like that. So we can decide to select only those which are above. So even when you come to the amounts, you find that these two are the ones who have the biggest amounts. So you see how we shall have selected the correct sample. These two are the ones with the correct amounts, and they are the ones we have selected. So monetary unit sampling is as simple as that. I've summarized it for you. First of all, if you determine the population, note the population, just know the population. For those who have not understood, note the population, then sample size. Sample size.
Thank you so much for watching. Make sure you subscribe to the channel.